My name is Milena and I'm the joint manager of the Baillie Gifford UK Growth Fund together with my colleague Ian McCombie. Ian and I are part of a team of 7 UK investors in Baillie Gifford. We look after 5.7 billion of specialist assets. This is our key UK equity retail offering and we are very keen to support it and see it grow. This is the last addition to our investment trust family in Baillie Gifford and we're very excited about it. The fund was formerly managed by Schroders and called the Schroders UK Growth Fund. We were fortunate to be awarded the mandate in April this year with the official handover of assets in the end of June. Despite there being no change to the investment policy and objective of the company, Ian and I have radically repositioned the portfolio, which now represents a concentrated selection of what we think are some of the best UK growth companies. As a result, the vast majority of the 49 inherited holdings have been sold and 42 new ones have been purchased. Our aim is to achieve a total return above the FTSE All-Share Index. And for us, the best way to do this is to invest and make very long-term investments in high-quality growth companies with sustainable competitive and cultural advantages. Even though we have no idea what share prices will do in the short run, we believe that over time, companies with superior cash flow growth will be rewarded with superior share price performance. We have a very pronounced growth bias, so any dividends paid out of underlying earnings are a byproduct of the investment process and of secondary importance to achieving capital growth. Yeah, Ian and I get asked this question fairly frequently, and our unequivocal and genuine answer is yes, there are. It is a demonstrable fact that the top 10 largest companies in the FTSE All-Share Index account for 40% of it, and that those top 10 are on the whole not what most people would describe as dynamic growth businesses. We would in fact go even further and argue that some of these large index constituents are facing disruptive changes, which could mean that they get seriously challenged over the next couple of decades, and as such their optically cheap valuations might be misleading. However, this is not a reason to get despondent about UK equities, as such a view ignores the 600 remaining companies in the FTSE All-Share and about 100 or so on AIM of reasonable size, and some of those companies we firmly believe have tremendous growth opportunities ahead of them. We've been able to find them in all sorts of different industries, from healthcare to consumer goods, industrials and niche financials. They are going after some very large markets, and if nurtured well, we think they have the competitive strengths to become multiples of their current size during our investment time horizon. I think our greatest point of differentiation is our exceptionally long-term time horizon. We are very patient investors. If we have the conviction that we have identified a truly great growth business, we would hold it for at least 5 years. And in fact, in Baillie Gifford, we've held most of our stocks for multiples of that period. And for us, what that allows is, it allows a greater chance for the competitive and the cultural strengths and the superior growth characteristics of our companies to emerge as the dominant influence on their share prices. It might sound like a truism, but we think that genuine long-term investment is a very challenging thing to do. We think most managers struggle with it. Our whole industry is geared into this constant state of hyperactivity. And I guess challenges to long-term investors become even more acute in periods such as this one when markets are quite jittery. Our second point of differentiation is the fact that we're very active investors. And what that means is that we pay very little attention to the underlying benchmark. We will back our judgment on individual holdings regardless of index inclusion, and we will never invest in a company simply to reduce risk. Well, we have extremely low predictive powers when it comes to determining what markets do in the next number of quarters. However, we are very long-term committed growth investors, and as such, we would view corrections such as these ones as an opportunity to increase our holdings in what we think are exceptional, undervalued growth franchises. And presently, Ian and I are very optimistic about the prospects of the holdings in our portfolio, as well as unearthing some new exciting ideas that might be included in due course.